Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
What if by changing just one thing, everything would be better financially for your family? How many of you would make that one change? How many of you want more money? That one paradigm shift and new skill set is the gap between you and the wealthiest families. It's the difference between being a borrower in life or being a builder. So welcome, congratulations. I'm Jason Sipple, and thank you for being here today. I want you to high five your neighbor or yourself, and many people could be here today, but they chose not to, which already puts you in a small percentage of people. You showed up for yourself and for those that you love, and that's awesome. And so in the next 6 hours, I'm gonna cover a little known secret used by the wealthiest families. Families like the Rockefellers, the Disneys. It's how they've built and multiplied their wealth for generations. And that one change is that paradigm shift between them and everyone else. And the best part is it's legal, it's simple, and it's available to each and every one of you. And what is that small change? That small change is nothing more than loving yourself more, paying yourself first. Because shockingly, we're giving away a huge chunk of money every time we get paid to them, to Wall Street, to the government, and to the banks. And I'm going to show you how to take back control from them. But first, would it be okay if I share a little bit about myself? Imagine this. A lot of what I'm going to do with you today is going to be imagination, because it's all built into reason, logic, prophecy. And imagine this. Imagine they give you the opportunity to lead a team, to take on an extra 30 hours of work a week, to manage 11 people directly, and to have a different job every day of the week. And here's the kicker. You make zero extra money and you have zero equity in this giant company you're building. How many of you would accept that? Nobody, right? You'd have to be insane to do that. But then it gets worse. Yes, much worse. Then imagine you start helping someone else build their dream, and now you're working 18 hours a day and you're making a third as much money. Who in their right mind would do that? Nobody, right? That was me. And in the back of that room in Mahwah, New Jersey, when I was one of the leaders of this peak performance coaching group, and as they're going through an exercise talking about what they want in life, how big they could dream, right? Who is going to be around them, how much money they're going to have, all your dreams and hopes and visions, and everyone's getting super pumped up. I broke down crying. I realized I was failing my boys and I was failing my wife in that moment. I don't know how, but it just hit me like a ton of bricks. That was a low point in my adult life. It was only 5.5 years ago. And I knew I needed help. And so when I came back, I knew that journey was over. That was no longer going to be what I was going to be spending my time doing. And so when I got back home, I went and I asked a friend and I said, brother, I need help. I need a financial philosophy. And he handed me a book. And I read that book on a Tuesday, And don't be impressed. It's only 91 pages. And I'm going to show you that book. Just got to stick around. And I read the book again the next day because I got so angry when I read that book, like really mad, like cursing, got to put money in the swear jar, mad. And I called my buddy up and I was like, what the bleep? Like, brother, why didn't you tell me about this? How long have you known about this? He's like, Jason, I've been practicing this for years, since 2007. And I learned directly from the author. And I was like, out of my mind. I was like, are you kidding me? Why didn't you tell me? And you know what he told me? He said, Sip, you weren't ready. And that's the truth. I wasn't ready. And that's where many people start, just not ready to hear this information. But by the time we're done today, you're going to know how they are making a ton of money with your money. You're going to learn how you can give yourself a 35% raise. How many of you want a 35% raise? And you're also going to know how money actually works and how by changing that one thing, you can not only have a better way to finance everything in your life, to build the opportunity fund, to take back control, and to give yourself guarantees. Because here's our reality. We've taken on too much risk in our lives. We continue to take on risk and we hope and we pray and we have faith things are going to work out. Well, guess what? If you're here, if you're in that small percentage of people, then you know or have the inkling that what you've been doing up to this point hasn't been working and you haven't been in control. So let's jump into this. So like I said, we're going to start off with some imagination. This is what R. Nelson Nash said. This is nothing more than imagination, reason, logic, and prophecy. So I want you to imagine in your mind, you're back in high school. You've just graduated. You're so excited about whatever comes next, or maybe just excited to be out of school. But I'm up leading and I ask a simple question. How many of you are going to be financially successful by the time you get to retirement age? And you're all going to pop your hands up. You're going to be screaming like, ooh, Jason, me. I mean, the next Elon, the next Mark Zuckerberg, the next Warren Buffett, maybe the next Trump. You're going to be so excited about what's coming next, what is possible. And you're going to think you can do anything because that's what your parents have been telling you your whole life. You can be anybody. You can do anything. Whatever you dream is within your grasp. But then something happens. It's slow, it's insidious, and it's almost imperceptible. By the time you reach retirement age, this statistic I'm about to share becomes your reality. 95% of folks, right? Only 5 out of 100 people are going to be financially secure by the time they reach retirement age. I want to ask you, is that acceptable? No, it is not. And how is that even possible? We live in the greatest country during the greatest period of time on earth. How can that statistic be possible? How can that be our reality? Now, it's not your reality. You've already showed up. You're already doing the hardest thing. You're giving your attention, your time, your energy to this. You're already in that 5%, right? You're already in that small percentage of people. But this has to change. Let's first talk about why most Americans are here, right? It's write this down, take a picture of this. The problem in America isn't so much what people don't know. It's not what we don't know. It's what we think we know that just ain't so. Isn't that the truth? Remember earlier who I said, I'm going to show you the book that changed my life? There's a lot of other people that know about this concept. Again, this is a concept used by the wealthiest families and a lot of names that you might already be familiar with. So let's talk about a couple of those folks. So let's talk about this guy. He had a rich dad and a poor dad and learned from both of them and learned about the importance of cash flow. And Robert Kiyosaki talks about this concept in his book, Second Chance. And then you got the big guy, the big man who changed my life, who actually set me on my journey for personal development back in 2019. Tony Robbins wrote about this in Money Master the Game, section 5.2. And then there's a book that I've been mentioning that's always within arm's reach for me, but by R. Nelson Nash, Becoming Your Own Banker. This is the version I have, the 5th edition. That's a picture of the 6th edition. But this book, giant font, super easy to read. When we connect and have a conversation, I'll even tell you how to read the book, what page to read first so you can get through it. And then you have my peers, my partners in this journey who've written Mapping Out the Millionaire Mystery. This is their personal journey and how they've applied it, just like R. Nelson Nash, with many of the same lessons and making it even simpler with Chris Naugle and Brent Kessler. And then Chris understands the importance of being your own bank and keeping the money in motion. So he wrote the Private Money Guide that kind of helps you navigate how you can do money or do deals with people, right? With individuals versus giant institutions. So let's talk about this really interesting concept. I want to ask you first, who learns quickly? Kids, right? Would you guys agree? Is that a fair statement that kids learn quickly? If you believe what I do, then that's a fair statement. And so let's think about back when either you were learning how to ride a bike or you were teaching, one of your children how to ride a bike. What happens? You get on the bike, and when you push the pedal down, what happens? You're pushing down, and the bike goes forward. Now, when you turn the handlebars to the right, what happens? The bike goes to the right. When you turn the handlebars to the left, what happens? The bike goes left. Simple. That's why there's a saying, it's as easy as riding a bike. But what would happen, and this is a YouTube video, by the way, you can go check it out. I didn't want to take the whole 7+ minutes to show you, but I really recommend this video, Backwards Bicycle. What would happen if the bike didn't work like that? What would happen if you turned the handlebars to the right and the bike went left? If you turned the handlebars to the left and the bike went right? How many of you think you could still ride that bike? I think I could. And I would just ask for that pause when I fell off the bike to make sure I was okay before you started laughing. I love cycling. I rode this morning, 5 a.m. I believe I could ride this bike, but our brains wouldn't be able to handle it because it's such a shift that the bike is not going to work how we were taught. And so what if our money worked exactly like this? What if all the things we've been taught, that we've been groomed by, is not actually how things work? What would we have to do? We'd have to relearn how to do it. And it might take a while. This is why I said earlier before I started, if you don't understand this, just write ... I don't understand it yet. Give yourself permission to learn how money actually works, because when you do, holy cow, everything's going to change. So let's go over why more people aren't more successful. I always talk about there's two sides of this. There's always the mindset side and the money side. So I'm just going to go through quickly a couple of the wealth killers. Anyone here not pay enough in taxes? Inflation is our money, I'll ask you this in a moment, but is inflation going to go up or down in the future? What have we seen historically? Market volatility, the market goes up, it comes down, it's all over the place. We never know. Consistently, over time, it might go up, but there's always dips. There's always market crashes. And interest, the volume of interest that we're paying others, what we pay percentage-wise to someone else. Because guess what? Banks and entities aren't giving us loans, right, Ace, for our good looks. It's not just that. They do it because logically, they make money. So let's look at the mindset side. What are some of the wealth killers on the mindset side? Following the status quo, the sheeple, right? Just following along. Oh, well, Jimmy did it. John did it. Stacy did it. Great. How is that working out for them? Sometimes it takes us pausing and asking a question. Then there's fear. And I break down all fears into two buckets. There's only two fears: fear of rejection or the fear of failure. Go ahead and use that if you like it. Fear of failure or the fear of rejection. Everything we're afraid of goes into either of those buckets, right? And then life distractions. When you all leave here today, and maybe this is not you, but often when we see something like, oh, that makes sense. Oh, I should do that. And then what happens? We get busy with our kids, our life, our patterns, our behaviors, our habits, and we get distracted. I can't tell you how many conversations I've had with someone. Oh, I've been around this for 2 years, for 6 years, for 10 years. And man, I wish I would have started earlier. I hear that as one of the most common things that is said to me. So now let's look. The mindset and the control is what we're looking for. So everything I went over is why more people aren't financially successful in their life. So let's talk about and what we're taught, of course, what we're taught, what we're groomed. But let's talk about some of the mysteries of money. Let's kind of level the playing field and agree on a few things. Let's define money first. What is your definition of money? Money is blank, but what is your definition of money? Money is nothing more than a tool. What company uses compound interest? And you might be thinking in your mind, banks, Jason. Maybe not, but banks. And I would just ask you, when you walk into the bank, like let's say Shane walks into the bank and you write Shane, takes a Sharpie, writes Shane on that $100 bill and hands it to the teller. Does that teller go back to the Shane deposit box, put the $100 bill in there, and it stays there until Shane needs it? No, of course not. As soon as your money is deposited in a bank, the bank has to move the money. It has to keep money in motion. It is a law of nature, right? If we don't move our bodies, what happens? We get stiff, we get old, we don't stay young and healthy. If we eat fish from a stale pond, what happens? We get sick. The money has to be flowing like water in a stream, okay? And then are your dollars worth more now or in the future? We kind of went over inflation a slide ago. But think about this. If this is hard to understand, think about how many candy bars you could buy 2 decades ago with $1. You could at least get a candy bar, if not a few, right? Maybe a buy one, get one for 50 cents. Today, you go to buy a candy bar for $1, and you can't even buy a candy bar, not even a third of a candy bar. I bought a Mounds bar, and of course, they make it giant. You know, I like Snickers, but the other day it was Mounds. And I bought a Mounds bar because I need some sweetness in my life. And the thing was ginormous and it cost like almost $3. So your dollar's always worth more today than it will be in the future. Taxes, again, are they going up or down in the future? And our reality is, this might freak you out, right now, taxes are historically low. It might not feel like it, but guess what? Probably not going to raise taxes a ton. They're just going to tax us on more things. But no matter what, if you look at usdebtclock.org, that'll give you an idea of where taxes are probably going in the future. And then finally, what do you know about your retirement account? And that's why I have this wonderful picture of Uncle Sam up here on my screen. So I'm going to pick somebody here. Let's pick Catherine, right? So Catherine, we're going to be partners. I'm going to be Uncle Sam and you're going to be you, okay? I'm just going to ask you a few questions and I want you all to play along like you're Catherine. So let's imagine this partnership. So at the beginning of this partnership, I'm going to say, hey, Catherine, let's be partners. We'll be 50-50 partners in this deal. But here's rule number 1. You are going to supply all the money, all of it. You're going to make all the deposits into our system, starting at a itty bitty little tiny seed and growing it to a big harvest. I'm not going to give any money, right? I'm not putting anything in. So Catherine, that's the first thing. How do you think Catherine's feeling about our partnership so far? It's probably starting off a little bit rocky, right? Next, I'm going to say, okay, Catherine, I'm going to be the best partner ever. I'm so charming. I'm going to be so considerate. I'm not going to tell you how to run your business at all. But when you need money, when you want to access the money, depending on when and how, there's going to be some rules. There might be some penalties. There might be some things that prohibit you from accessing the money to a certain age without penalty. Remember, you're putting all the money in and I'm going to make the rules. You put the money in, I'm going to make the rules. Are we cool? And then finally, if you're feeling a little bit uneasy, Catherine, I understand. But again, I am partners with millions of people. I have a track record to show for it. I'm the best. I'm the best Uncle Tio ever. So now when you take that little seed from the beginning and you grow it into this stupendous, giant harvest to live off of later in life, I'm going to come back into the picture. I'm going to go sidle on up. You haven't seen me in years, Catherine. I'm going to go, hey, psst, Catherine, I'm going to need that 34.5%, maybe 40%. And you're going to give it to me because that's our agreement. How many of you would do that partnership? Anybody? Would anybody? I want to know who you are if you'll do that partnership because I'm going to call you. We got some stuff we can maybe do together. Just kidding. But that is the agreement we have with our retirement account. Not only do we not understand fully, usually, what they're participating in, but that's the kind of partnership. So if any of that made you uncomfortable, I'd almost apologize, but I'm just going to say good. Because what we just covered is what is money? Nothing more than a tool. We just covered how money has to stay in motion. Your dollars are worth more today than in the future. Taxes are probably going up. And Uncle Sam is not a great partner. So if any of that made you uncomfortable, that's okay. Because remember, we're shifting the paradigm and we're only changing one thing, which is what I'm about to go through. What is that one thing? How do we pay ourselves first? And what does that look like? So let's jump in and show you how easy this method is. It's only 3 parts, right? First, it's a machine. And I already talked about how it's whole life insurance. So you don't have to go running away, scream out of the room, right? It's nothing more than whole life insurance, which I'm going to show you more of exactly what that machine is. And it's a marathon. This is not a get rich quick scheme. If you saw my profile, I like to do marathons, but only after I swim really far, like 2.4 miles, and ride my bike over 100 miles, 112 miles or more. Then I'll run. Other than that, I don't want any part of running. But it's a marathon. This is the long game. This is your whole life, like in the name. And then finally, the millionaire mystery. I'm going to show you how a client, by changing one thing, mapped out his mystery and how you can do the same thing. And it's not really a mystery. It's really kind of boring, but we're kind of making it sexy so you all are entertained and you can see how money really works. So let's jump into what is this machine, this magical, mysterious machine that you are talking about, Jason. What is it? Well, let me tell you. It is nothing more than a dividend-paying whole life insurance policy from a mutually owned company, right? This is your specially engineered cash-rich policy for yourself from a mutually owned company. And let me tell you something about all the mutuals we work with. All 5 of them have been profitable every year they've been in business. And they've all been open for well over 100 years. So profitable every year, well over 100 years. It's pretty impressive. What is it not? Always comes up every time I give this talk. We're not talking about IULs, VULs, term policies, because there's no control and no guarantees in any of those things. They don't make for a good banking partner. Do they work in other places? Yes. Are they a good banking partner? No. Okay, so we've got that clear. What it is, what it's not. It's a whole life policy that's specially engineered from a mutually owned company. So let's play a little game here. This is interactive. So if you got a pen and paper, grab it, draw yourself a cross or a T chart. In the top left, you're going to write bank. In the top right, you're going to write policy. Under both, you're going to write the word liquid. What is your definition of liquid or liquidity? Mine is just not locked up in financial prison. Is that fair? You guys like that arrangement? So if you have a high yield, write down whatever your percentage you're earning in. If not, write down 0.07%. That's what the average conventional bank is paying as of about a year ago. So I'm sure that's went down a little bit. And under policy, wrote 3.25%. That's guarantee number 1, right? Guarantee number 1. So G1, that's what that stands for. And that's uninterrupted and compounding from the day that you make the deposit. Now under bank, you have taxable. All the growth on the 4.75%, 4%, 4.25%, whatever your high yield is taxable growth at the end of that fiscal year. The policy, tax-free. It's tax-free loans, tax-free growth, tax-free distribution. Proper term is tax advantaged. If you're already looking, left side bank, you have liquidity, you have growth, and you have taxable growth. On the other side, you have liquidity as well. You have guaranteed growth, and you have tax-free growth. Now, under bank, you have unstable. And you might say, Jason, what about the FDIC sticker? I'd say, cool, great point. But let's look at how banks actually practice. Let's go back to the beginning of 2023. Between March and May, 3 major banks failed. Silicon Valley Bank, the Signature Bank, and one other bank, and they're all well over $100 billion failures. That's ludicrous. How do you fail and have over $100 billion? Well, if you ask why, if you peel the onion, it's simple. Banks practice fractional lending. When you make a $10,000 deposit in the bank, they lend 90%, and they basically turn that 10 grand into $100,000 through a series of loans. Well, then how do they fail? Well, when people get nervous about what they're doing and them not actually having the money, a run on the banks happen and people go to get their money and it's not actually there. This is why banks fail. This is why over 500 banks have failed since 2000. How many large mutually owned companies have failed in that same time period? 0. Well, why? Why is there stability on the policy side? They practice a different economy. They practice Austrian economics, which means it's similar to going back on the gold standard back in the 70s, right? The dollar is worth something. You exchange it for something. It's backed by something. It's called sound money. That's what Austrian economics means. So when you have your premium deposits, when you take a loan, you're borrowing against them dollar for dollar. I hope that makes sense. And they're also stable because they're only betting on one thing. Remember, it's whole life insurance. They're only betting on how long you and I live, how long Shane and I live, how long do we pay our premium deposits into our system. And guess what? They're actuarial scientists. They know when Jason Sippel's passing away and of what and when. So all they're looking for is the right partners to be able to deliver on that legacy piece later. Does that make sense? Now under bank, you have unprotected. What do I mean by unprotected? Great question. Unprotected simply means that any of you entrepreneurs or people that own properties and different things, if someone got hurt on that property or in your business, guess what? If you have money in a regular bank, if you're storing your capital in a bank, guess what? A good attorney, the ones you see all over the billboards, all over the United States, can get at that money because that money is public. In a policy, it's protected. It's protected against liens and judgment because it's private. Now, it varies state to state because life insurance is state statute, but the majority of states are fully protected. And even when not fully protected, guess what? It's more protected than it is in a policy. And so far, if we're looking at the left side and the right side, if you're keeping score, on the right side, we have all red, and on the left side, we have all green, right? Liquidity, guaranteed growth, tax-free growth away from Uncle Sam in a stable environment that is protected from attorneys, right? Another wealth killer. Now, on the bank side, if we have our money stored there and we take the money out, is there any protection for our family? Is there any cherry on top? No, there's not. There's no death benefit. Now, on the policy side, this is the cherry on top. For me as a father, this is one of the most important things. Knowing that if I'm no longer here, if I graduate early, there's a tax-free death benefit that is a multiple of whatever the amount of cash value I have in the policy. And so now the question for all of you, for the high yield folks, is if you were on the bank's board of directors and they asked you, hey, where do we, Shane and everyone else with the high yield, where do we need to store our money that has to be stable, that has to be protected, and that has to be accessible, has to be liquid? Where would you say, on the left side or the right side? Anthony says the policy, right? Exactly. The policy side. And the banks are pretty smart too. They have 4x the amount of whole life that they have purchased. If you've ever wondered why are there so many VPs, so many directors in these banking institutions, it's because they are storing all of their capital. They have more money, $225 billion plus in bank-owned life insurance. I haven't said this yet. I usually say this many times during this talk. Don't believe anything I'm telling you. I want each and every person thinking for yourself. I put this chart together because I was doing what you're doing in this moment and researching this and going deep down the rabbit hole to see how is this possible. By changing one thing, I could have back control. I could take back charge of my money, and I could eventually, over time, over the distance, over the marathon, have all of that money coming back to my family. So let's talk about how your money flows. This is a great example. I'm going to go pretty quickly through it, but let's look at this. Let's say you're working with me. You all trust me now, Jason, the honest banker. So now you're storing your money, and we're going to go back and going to pick someone else. I'm scrolling through your names. Oh, I'm going to go back to Catherine because she said she was nervous. Catherine, guess what? You're on The Price is Right. You are now buying a new vehicle through your specially engineered policy, and you're storing your money at a bank, at Jason's bank. I'm super generous, and I am giving you, Catherine, 4%. You're all stoked. You imagine that car, smell that fresh car, new scent. You know what your tires are going to look like, what your mats are going to look like, and you come to get your money out of the bank because you've been disciplined. You've been saving, doing what most people aren't doing. You've been paying yourself first. And I tell you, hey, Catherine, don't take a loan or don't take your money out of the bank. Let me give you a loan. Let's keep your money earning at 4%. and you take a loan from me at 6%. And at the end of 5 years, 60 months, you will have made money. Growing money at 4%, borrowing at 6%. Am I telling you the truth? Simple question, yes or no. Am I telling Catherine the truth? Well, Catherine, if you trusted me, you would have made money. You would have made $1,526. Now, it doesn't matter. You can add zeros. You can buy yourself a Ferrari. But no matter what, let's stop looking at the interest percentage and look at the cash flow that actually happens. And how did this happen? The money kept compounding uninterrupted over time. Again, uninterrupted growth. And the loan was on a depreciating scale. So as she paid it back, it got smaller and smaller. And over time, she made money growing at 4 and borrowing at 6. And we just show you that because I want you to start thinking differently with how you look at your money. So now that I've established trust, worthiness as a banker, and anybody that wants to schedule a call with me, you can go ahead and jump in and scan that QR code in the middle. It should bring you right to my calendar. But now, since I'm giving 4%, better than most banks in the States right now, now you guys are fine depositing $100,000 in my banking system, in Jason's bank, Jason the Honest Banker. Now, as soon as you make that deposit, is that a liability or an asset to my bank? And hopefully by now you understand that that's a liability because I have to pay you 4%. So I'm on the hook. My bank's on the hook. So what do I have to do? Remember the law of motion? I've got to put that money in motion right away. So now, because we're trying to keep up with the Jones and maybe we have more family staying with us or we like the host, we get a nice, big, beautiful home. And my bank is going to now charge you 7%. Well, when you pay the seller has to make a deposit. The money goes out and does what? It comes right back to my bank. And then what happens? You've got this big, blue, beautiful house. You need a blue BMW to go with it. And now you take another loan at 8% this time, all right? And the money goes to the car dealer and it comes back. So it's going out and it's coming back. Just watch the pattern. This is what I'm teaching you. Think about your banking system here. And now your spouse, they love the new home, but now your kids want a pool and you've been promising for years. So now you build a pool and you take a home remodel, or maybe you expand the kitchen for entertainment, and now you get another loan. And every time the bank's charging you a little bit more as they take it on more risk. And now you forgot that the bigger home required furniture for the guest. You need to buy beds, garbage cans, mats, all of the stuff, maybe a new silverware set. And now you end up with high interest debt because you didn't pay off the cards before they were 0% and switched to 29.99%. And so 12% seems pretty good. And you take a loan from my bank, the Honest Bank, and now you put money back in. So let's look at the spread. You're making 4% on your 100 grand. Let's check out what Jason's bank is making. 7 minus 4 is 3%. 8 minus 4 is 4. 9 minus 4 is 5. 12 minus 4 is 8. Let's add these up, right? Just do it in your head. This little 20. We've got 20. I've been paying you 4. The bank just made 20. Is that 16% bigger or 5 times more? 5 times more. This is how the banks are making 500% annually on your money. On average, every dollar is deposited. Remember I told you to think for yourself? If you want to look into this, go wherever you bank. Go to BauerFinancial.com. Banks make no less than 400 to 1,300% annually on every dollar that we keep in the banks. That's just nuts. That's nuts. What if we controlled the banking function? Wouldn't logic dictate that we would have more money? What I just showed you is banks, through a series of loans, moving the money in and out, keeping it in motion, make 400 to 1,300% on our money. So if we had that banking function, wouldn't we stand to eventually make that kind of money on our money by keeping it in our family? Yes. So let's look at, remember, earlier you told me you'd love to have a 35% raise. So let's look at our annual patterns of spending. Now, I've had over 3,000 conversations with you all, and I can tell you most people are spending way more than 20 cents of every dollar on their automobiles. The next 30 cents is on housing, 40% to everything else, lifestyle, and we're making a very generous assumption that people are saving 10%. since 1985, the average savings rate in the US is, drum roll, what do you think it is? Is it higher or lower than 10%? It is lower. Since 85, our average savings rate has typically been under 5%. A couple months ago, we were at 4.6%. So we're being generous there. Now let's look at how much interest that we're paying to the banks or wherever we finance the vehicle, right? Because we've either paid cash, we financed, or leased the things in our life. So now when we start going through this, 5 cents of every 20 cents for the automobile is interest. So what happens if we take back charge of this? And we're going to show you the map out that millionaire mystery later on, how this actually works. But just look at the change. Like I'm just showing you, like if this was a seesaw and you got someone really heavy on this side, eventually we're evening it and we're going to tilt this in your favor. So now with housing, you got 35 or 25 cents of every 30 cents. Almost 70 to 80% is going to interest with a home if you've moved into that home in the last 7 years or less. And then everything else, we got another 5 cents. And so by just taking back control of that money and moving the interest into our savings, now we have an additional 35 cents. 45 cents of every dollar is being paid to us. That's changing the one thing. So this pattern of spending has been true since the 60s. So wouldn't you think that if we can shift this, that we could all have more control and guarantees in our life, keeping more money in our family from here and forward? So let's look under the hood together and let's look at a better way to finance everything. Because I know, without you even telling me, that everyone here to get their vehicles, whether it's a beautiful truck like this or your car, or your station wagon, or whatever you have, you've either what? There's 3 ways you buy your vehicles. You've either paid cash because you didn't want to pay a payment to anybody, and now you never earn money on that money. And you've either financed it, so you're paying interest to somebody else, or you've leased it, so you're renting it, or maybe you stole it, but then I won't be able to help you get a car if you have grand theft auto. So I know no one here has done that. So let's look at this better way of purchasing things. So Catherine, you're up again. Now you're going to make your deposits into your banking system, okay? And we're going to call your premiums deposits because they're payments to yourself. So I want you all to get in the language of making premium deposits. And your age doesn't matter, whether you're 20, 30, 40, 50, 60, 70. As long as you're healthy, as long as you're insurable, your age doesn't matter with the way we specially engineer these. And the death benefit, again, super important, but it doesn't really affect your banking piece of things because we're engineering these for high cash value and lower death benefit. So now, Catherine, you're going to deposit either $833 a month or $10,000 a year into your banking system. After 3 years of making deposits, you're going to buy your new car. And instead of paying $483 a month, you're just going to round up to $500 and you're going to pay yourself back, your system back, $6,000 a year or $500 a month. Because why? I'm not going to let you steal the peas. If it's your bank, you hopefully will treat your banking system better than you would treat someone else's bank. Fair? And then over that first 7 years, Catherine's going to put $70,000 into her policy or your policy, play along if, I'm not talking to you directly. And she's going to pay herself back $30,000 and she's taking a $25,000 loan. So at the end of this period of time, $100,000 deposited, $25,000 out to buy the new vehicle, total cash, $75,000. Look at the cash value in that account, in your specially engineered whole life policy, $67,000. How many of you here have ever purchased a car and at the end of the 5 years of financing have had 90 cents or more of every dollar you spent on the car? Anybody? If you have, I want to hear about your story. This is where the magic starts to happen, like Shane said. Now I'm going to do something crazy, like crazy. Something I would never do. We would never teach you how to do this. But now Catherine's like, you know what, Jason? I'm done making deposits into my account, but I need another car. This car is gummed up, gucked up. It's a mess. So I'm going to go ahead and buy another vehicle, borrow from my cash value. I'm going to make deposits back into my account because I am still an honest banker. And at the end of that period, I'm going to put $30,000 for the payment. $25,000 is the loan. But look, the values went up $23,592. Catherine has just made money on the second vehicle she bought with the policy because every year, why? It keeps growing uninterrupted and compounding forever. Keeps going this way no matter what. And I can't do anything about it. It's just how these mutual companies are set up. And so let's go over a couple of the rules here. 3 rules. First rule should be the only rule, but you got to pay yourself first as if your life depends on it. It's the first law of wealth. Depending on your age, somewhere between 10 and 20%. By the way, the 1% have been paying themselves 38% on average since 1910. So if you don't believe me, just do what the wealthy do. Number 2 is pay yourself with interest. Remember, we're not given loans because of our good looks and charm. We're given loans because someone else is logically making money on our money. And then we want to recycle and recapture all that money by continuing to make deposits into our account and making payments back to ourselves. This is how we change this one thing, where we're storing the money. So again, if this works for the car, for the truck, what else can it work for? Well, let's go through and map out how one of our clients did exactly this. He saw this presentation, this very, very presentation done by someone else. And at the end, this is his actual debt. He walked up to the table like anyone who schedules a call with me will do. And you'll come to me and we'll dive into this stuff. I'll ask you, how much are you saving? How much are you paying yourself? How much of your discretionary income are you keeping? What are you spending it on? Well, this guy, 45-year-old male, a chiropractor, came up after and he said, hey, can you guys help me? And we said the thing we always say, it depends. Are you willing to change one thing? And he said, yes. Because I asked him, or we asked him, hey, doc, where are you storing your money? Are you putting money into a qualified plan? He said, yes, I'm putting about 25 grand a year into my qualified plan. We said, great. Well, if you keep with your no plan, it's going to take you 19 years and you'll pay $69,000 a year to someone else for the next 19 years. Or let's map out what it could look like if you change one thing. So he made his deposit into his account. He took an immediate loan. And when we say immediate, we mean within the first 30 days, pretty immediate. Takes out that cash value. And what's he do? Is that new money for him to go spend? No, that'd be crazy. No, he pays off Discover, he pays off Lowe's, and he recaptures $448 a month. Again, that's not new money. That money comes back to him. Because we're only changing one thing, where he's storing his surplus, his savings, money that used to go to qualified money. Year 2, deposits the same amount, and look what happens. And the cash value goes up. Makes the payments back to himself. You add those together. You take that $21,000, and what's he do? Pays off Nordstrom's, Wells Fargo, and the private loan, and pays down the Beamer. Remember, he was keeping up with the Jones. And now he's almost recaptured within 2 years, $24,000 a year, almost. More than $22,000 a year. Year 3, this doc does the same thing. Remember, I'm taking something super simple, super boring. We're going fast through a lot of different numbers. So if you're glazing over a wall of numbers, just hold space that everything I'm telling you happens exactly like I'm showing you. It's like going to a movie. Suspend disbelief. 25 grand put in, and look what happens. Something super cool. He hits the efficiency point. It's not always that fast, but this doc, year 3, $25,541, pays off the BMW, pays off the boat, recaptures more money back to himself. We go to year 4, the marathon, remember? How much do we put in? $25K a year. We've taken out loans immediately every year to pay down the debts, to recapture the money. How much is left in the policy? You might think in your head, 20 grand. No, it is more than that. All $75,000 that's been deposited is still in the policy. And all of the cash value is earning you uninterrupted compound interest. So let's go to year 4. Doc makes the same deposit. It's worth more. Payments back to himself. You add them up. Nothing exciting happens that year, right? The condo gets paid down a little bit. Still got a condo bill. Year 5, makes the same deposit, goes up again, pays off the condo, pays down the home, almost back $4,500 a month. Anybody else want $4,500 a month that used to go to other families coming back to you? If your number's 1,000, if your number's 2,000, 3,000, imagine that money, see that money flowing back to you. Would that be impactful? Now, year 6, something interesting happens. He makes the same deposit, but now he can't fit all 25,000 into this account. So he takes some of that money that he's paying back to himself. Maybe he's earning a little bit more. He makes another policy, makes that same $25,000 deposit. So now he's at the point that he can't fit everything back into that first policy. He's got two payments, cash value, the two policies, the payments, 82 grand, 6 years. All the debt is gone, blasted away through the policy. And now he's going to pay his policy back. And I'm going to show you that. This is how we map out the millionaire mystery. So let me just tell you what happened in a high level. We've changed one thing, where he was storing his capital. He was putting it towards a future self in a qualified plan before. Now we put it in a specially engineered for him policy. Within 6 years, we recaptured $5,777. Whatever your plan is, when we go through the strategy call, I will walk you through step by step how this looks, how much interest you'll recapture, how long it'll take, and all you have to do is change one thing. Now, if you think you can do that with a plan and you can follow the plan, follow instructions, you can do this. Promise. I've helped over 3,000 people get started doing this. And so, again, mapping out this millionaire mystery, I always love to ask, how do you eat an elephant? You're right. It's one bite at a time. And the man or the woman didn't fall to the top of the mountain, did they? They had to walk there step by step by step. And by the way, no elephants were hurt in the making of this, so we're elephant friendly here, but it was one bite at a time. I promised we'd map out the millionaire mystery. So look what happens if the doc kept paying himself back for the condo, for the home, for the duration of what he agreed to pay the banks in the past. This 251 months, 224 months, $500,000. But it gets better because we didn't include the interest that he's earning on that money that he's paying back to himself. $750,000 just from the condo and the home alone. The doc is well over $1 million that he's brought back to his family. How many of you would like to do the same thing? So now that you all know this, if you weren't doing this, a little harsh, if you weren't doing this, aren't we stealing? Aren't you stealing from your kids, your grandkids, your great-great-grandkids? If you don't make that one change of paying yourself first and storing it someplace where it gives you control and guarantees. Like our buddy Warren said, who's sitting on $300+ billion of cash, if poor people would just do what rich people do, they wouldn't be poor anymore. So now that we're at the end of our time together, I've just showed you how the banks are making 400 to 1,300% annually on your money. How many of you would like to make that kind of return on your money? We showed you how to turn your debts into assets, a better way to finance everything in your life while keeping control of your money. And that's the power of becoming your own bank. And you know who knows about this? Rich people. So guess what? Ladies and gentlemen, now you are part of the club. And as any journey ends, you have a decision to make. You have two paths. You're either going to take this information and say, hey, that's cool. Sounds too good to be true, which I hear all the time. And you're going to just keep training and learning and thinking, I should do this. Or you'll book a call and you'll start to do this. Because either way, whether you live or you die, are you better with or without this? I've helped thousands of people that are sitting right where you're at right now. So if you want to know how you can do this and have a plan that's custom built for you, scan that QR code. It starts with your habits, following the laws of wealth, and we'll show you how to implement a system that you own. Not me, not any of my peers, that you own. And if you don't, that's okay as well. Because either way, I am so blessed to have been here with you today to serve you, because you gave me your greatest gift, your attention, your time, your focus. And I don't take that lightly. So either way, I am blessed to be here with you today. Like Shane and others have put in the chat, Anthony, that I've helped get started on this journey. Scan the QR code, book the call with me. You won't regret it. Worst case scenario, you have a starting point to know what the next step for you to take is to recapture, recycle, and control your money. So be blessed. I'll see you guys all in a week, and come back and learn again. For everyone that's new, thank you for being here. Come back next week as well. I'll talk to you all soon. Be blessed. Have a great rest of your week. Thank you.